Hello everyone, welcome to another Zerodha Educate webinar. In today's session, we have Mahesh Patil, the Co-Chief Investment Officer of Aditya Birla Sun Life AMC with us. As you may know, he is one of the most respected names in the fund management space. Mahesh has over 23 years of rich experience in fund and investment management. He started with Aditya Birla as a fund manager in 2005. As the co-CIO, he now leads a team of over 20, comprising of both fund managers and analysts, and they manage close to about 90,000 crores in equity assets. He currently manages the large cap funds like Aditya Birla Sun Life Frontline Equity, Aditya Birla Sun Life Top 100, and Aditya Birla Sun Life Balanced 95 Fund. By the way, I have to mention this. Back in Feb 2017, when we decided to start the Zerodha Educate webinar series, the very first webinar we conducted was on ELSS, titled Demystifying ELSS, and this was done by Mahesh Patil. And 2 years later, we are back with him to learn more. Mahesh, thank you so much for joining us for this webinar.
Yeah, it's my pleasure to be on this. Yeah.
Yeah, thanks, Mahesh.
Yeah.
Mahesh, so let's start with a little bit of macro. Can you give us a sense in terms of where we are in the economic cycle?
Yeah, so if you look at the economic cycle from an India perspective, then we've seen the lows which were created in terms of growth after the demonetization, when there was clearly a slowdown in the economy. And also to some extent, when GST was implemented, there was some disruption. I think from that lows, we are clearly seeing improvement in the overall economic growth. And it's still not as great. Like we've seen that in the economic cycle of India, we've seen India's GDP growth has kind of ranged between around 4.5%, 5% to a high of around 9%. Currently, we are expecting the GDP growth this year or in the next fiscal year, FY20, to be around 7.1% or so. So in that sense, we are somewhere in the mid of the economic cycle. But if you look at on the global front, clearly there has been a kind of a slight slowdown. There's a synchronous slowdown in the global growth. US, which was growing very strong for the last 1.5 years, is seeing kind of its economic growth has peaked out because to large extent, the global growth, what we saw in the developed markets, was driven by the stimulus, okay, which was there, both fiscal and monetary stimulus, which is likely to wane down. Even globally, China is kind of peaked out in terms of its economic cycle, and it's from a peak of around 8-9% growth, which it recorded in the last decade. It's now struggling to grow above 6%. So in the global backdrop where economic growth is kind of peaked out, India, I would say, is somewhere in the mid of the economic cycle, and we are seeing now slowly growth coming back on the consumption side, and investments are still lagging private sector capex, but that will also pick up a year down the line. And but I think overall we should see the growth in Indian economy also should probably not exceed around 7.5 to 7.8% in this cycle.
Sure. Mahesh, do you foresee a situation where we could go back to the previous seen highs in terms of GDP growth? If yes, then would it be possible to put some sort of timeline there, according to you?
So, as I mentioned earlier, I mean, in the previous cycle, we have seen GDP growth touch around 9.5%. That looks unlikely in the current context because we don't have the tailwind of strong global economic growth. So, global economy is kind of peaked out and is seeing some slowdown. And while we are still at a pace where we're seeing some improvement in in our economic growth, but in the absence of a strong global tailwind, it's difficult for us to really scale that peak. So I would say the growth should probably, be in the region of around 7.1 to 7.5% or so over the next couple of years. I think difficult for us to really move above the 8 kind of percentage growth rate.
Right. Okay, so speaking for the next, let's say, 5 or 10 years, what are some important factors that you think will influence growth, and likewise, what are some of the risks that you see for this growth to happen?
So if you look at the India's GDP growth overall, the biggest component of that has been consumption, and that's also been a pretty steady in terms of the overall growth rate, and that's the reason why you see India's GDP growth, even in kind of difficult times, has still been around 5.5% or so. So I think consumption is driven by the demographics. We've seen also consumption driven by the rising per capita incomes, some amount of premiumization which is happening, urbanization. So I think that trajectory of consumption leading the growth will continue, I think, for India. I think that their demographics will play out over the next 10 years or even the next 15, 20 years. And that should be the mainstay for the overall economic growth. And in the near term, we are seeing some kind of a stimulus to that being given by the budget. Also, this time we've seen the budget has been friendly to drive consumption. There is a stimulus of almost 1 lakh crores, which has been given in this budget in terms of increase in the farm income and also for the middle and lower middle class. I think we should help to stimulate consumption. And investments also is the other leg of that, but that is slightly, at least over longer term, clearly India again has a lot of potential for investments in infrastructure space. And there again, the challenge would be in terms of capital. Okay, we don't have domestic savings to do that, so we require foreign capital, which should feed into it. But again, clearly, there is enough potential over there, both in terms of in the infrastructure space, even housing sector for that matter. I mean, we have seen the housing sector currently going through a slowdown, but there is a good potential demand for housing in India. There is a demand for housing at the right price. And I think with the reforms, what we are seeing in the real estate sector, I think over a longer term, I think that sector should also pick up. So I think it will be a combination of consumption, okay, which is the largest component and which should see a more steady increase. And steadily over a period of time, I think investments should also aid. Private sector capex is still very poor. We haven't seen private sector capex doing well over the last 3 years. But there again, we've seen capacity utilization levels starting to move up. So I think that should also kind of be another leg of driver for the overall growth, which we expect to pick up a year down the line, especially after election. I think that could also continue to be one other leg of growth, which can keep our growth rate in that vicinity of around 7.5%.
Sure. Mahesh, you spoke about housing sector consumption, private sector capex going high, and these are the drivers for the growth, for the 7.5% growth that you are expecting, right? So, given this, what are the risks that you see which may kind of hamper this? So, what are the things that we need to really look out for?
So I think the risk for this growth could come in terms of, say, for example, if the monetary policy and on the fiscal side, right? So
Yeah.
if the monetary policy is tighter, then you could see that impacting availability of, because the consumption is also driven not only by the income, but also a leverage, which is increasing at the personal, at the individual level. And if interest rates go up because of a tighter monetary policy, then that could impact the consumption at the margin. Also, on the fiscal side, we're facing some kind of pressure on the fiscal side. Though in the budget, the finance minister has tried to keep the fiscal deficit at around 3.4%. But clearly, there are pressure there on the revenue side. But if oil prices go up, then there could be further pressure on the fisc. And that will really constrains the government ability to really put or invest into infrastructure, which is another driver for the overall GDP growth. So I would say oil prices going up sharply would clearly be a dampener here, because that will not only raise inflation, which poses risk for interest rates to go up, but also leaves little room for the government for them to invest into the infrastructure and really creating the investments required for sustainable longer term growth.
Sure. Mahesh, if I remember right, in the Aditya Birla 2019 year outlook, you had said that yeah, you had said that the corporate profit seems to be bottoming out. So, what is your take on that now?
Yeah, so the corporate profits have been lagging behind for last almost 3.5 to 4 years, the nominal GDP growth. Normally, corporate profits over a longer term grow in line with the nominal GDP growth, in fact, at slightly higher than that. And the reasons of that have been varied. I mean, we've seen some slowdown in the economy in the last 2 3 years. There were disruptions, what we saw in a few because of demonetization, GST. Certain sectors like the banking sector went through a lot of problem in terms of NPAs. The pharma sector also had to see a significant erosion in its profitability because of the pricing pressure in the US generic space. So there are multiple reasons why the profits were depressed. And if you look at the corporate profit to GDP, then probably it will be the lowest level compared to the last 8 years or so. So I think there are now signs that things are bottoming out, because the financial services sector and mainly the banks, we are seeing, especially the corporate banks, right, which saw a huge erosion in their profit because of the huge NPA. We are seeing the NPA cycle has peaked out. Incrementally, the slippages by the corporate banks would be lower, and overall profitability, also margin improvement, is on the cards. So that sector clearly is looking things that the profitability and the ROAs for these banks will improve. And then the broader recovery, what we are seeing in the economy, should drive growth across many sectors, including the consumers, the consumer discretionary space. So I think by and large, we're seeing that most of the sectors are now starting to participate in the growth. There are some few sectors like the telecom sector, for example, where it's still struggling. But the participation, broad-based participation across sectors makes us believe that the growth, profit growth in the next couple of years should be much stronger than what we've seen in the last 4 years. And also as the operating leverage starts to kick in for a lot of companies which were operating at capacity utilization levels which were suboptimal, I think that should also provide the lever for profit growth to be higher than the top line growth. So we are expecting that the earnings growth over the next couple of years should be around mid-teens or so, which is actually a tad higher than the long-term earnings growth, which is around 13.5% for the Nifty earnings.
So that's pegging roughly close to about 15%. Is that right?
Yeah, somewhere around that. I mean, this is what the current estimates are. Depending on how the global factors are, you could see that varying up and down, but clearly it should be in the double digits.
Okay. That's nice. That's nice. Mahesh, recently there's been a sharp correction in the markets beneath the headline indices, right? Nifty Midcap 100, I think, is down close to 18% in the last year, while the small cap 100 is, I think, close to double of that, close to about 30%. Mid cap, I think, is trading at a discount to Nifty 52. So, what should investors who are entering the markets and newly and the existing investors do in this scenario, in this backdrop?
Yeah, so I think you're right. In the last 1 year, we've seen a significant correction in the broader market, which is not really visible in the Nifty movement, which has been more or less flattish. And that has taken a lot of erosion of wealth for investors. And a lot of investors would seen that in their portfolio, the fall would have been much severe, especially in a few stocks. The correction would be in excess of around 25%. In fact, in the BSE 500, 40% of the companies are returns are below minus 25%. So I think in this kind of an environment, from investors' perspective, I think they should, uh, I mean, obviously, they should trade with caution, invest with caution. But again, at the same time, not be deterred because a lot of these stocks are now available at uh, good value, right? Especially in the small cap and mid cap space. And there is always excesses which happen in the market, especially when the sentiment is weak, which is currently the scenario. So this is a good time to actually find value in the market, maintain a discipline, invest into good stocks where you can buy them actually at a reasonable price. And if you do that, then one can expect good returns over the medium to longer term. So it's a good time to actually start doing bargain hunting, I think, in the market, provided only in those companies where the fundamentals are sound and the management quality also is reasonable.
Right. Actually, that leads me to another interesting question. So, I mean, we've seen numerous stocks like Vakranji, PC Jewelers, DHFL fall anywhere between 50 to 90% from their highs on on the back of corporate governance issues and other issues. We've seen investors get caught in this, even though this is a timeless tale for investors, both mutual fund and stock pickers. What advice would you give in terms of navigating between the quality and the rotten apples out there?
So I think for individual investors, for the common investors investing into markets, equity markets, especially in the smaller names, the small caps, is always hazardous. And we've seen investors burn their fingers time and again entering into stocks, mainly driven by momentum or price action. I mean, that's what really gravitates or is one of the decisions, okay, which investors do when they're investing in the stocks. So I think again, not to get carried away by momentum. If you're investing directly, it's better to do your own research on the company. Again, management quality is very important. Obviously, very difficult to assess that for a normal investor, and that's why I would advise that if somebody is wanting to invest into the small cap space, then it's better to actually uh, give that money to be managed to professional fund managers, mutual fund portfolio manager services, where there is a continuous tracking which is there and monitoring which is there in the stocks. If there are red signals and warning signals, one can take action at the right time before it is too late. Because normally investors, when they get caught in some of these stocks, it's very too late for them to really react and to recover any part of their initial investments. So I think due diligence is important. Trying to really bet on the management quality, focus on that is important. And if you can't do that, then it's best to really give that money to professional managers to really manage that money.
Sure, point taken there, Mahesh. Mahesh, just a couple of more questions on shifting focus to mutual funds before I let you go. There have been concerns about pledged holdings and mutual funds. Although these developments are in flux, should investors be concerned here?
So I think the we've seen the in recently in a few stocks, okay, where the promoter holding has been pledged, seen a huge volatility and sharp correction in the stocks. Yeah, I think investors need to be, I would say, worried, but at least should be aware about when they're investing into a stock, whether there are any pledges by the promoters. Again, there are various reasons why the promoters would have raised money, okay, to invest into other businesses. But again, I think there are two aspects to it. I think one is fundamentally, if the company, okay, which one is investing into is sound and the business there is on a strong footing, then I think because of promoter pledges or reasons, if there is volatility or sharp correction, in the stock prices, I think one should not be too worried about that. We've seen those instances where stocks correct and they bounce back also once the dust settles. But clearly, I think in the starting point itself, when you are investing into a company, wherever you find that there is a large portion of the promoter holding which has been pledged, then I think one needs to be a bit cautious, and the alarm bells need to be ringing, and one is to really do further due diligence before one invests in the underlying companies.
Right, noted, Mahesh. This question is about passive funds. There seems to be a slow but steady trickle into of investors into passive funds, although we are probably decades away to reach a stage similar to the US. Is it time Indian investors started looking at passive investments seriously? What's your take on that?
Yeah, so that's an interesting question and a debate which is going on in terms of whether passive funds would start to really get significant importance, especially in terms of when they get compared vis-a-vis the actively managed funds, and what kind of an alpha the actively managed funds can deliver over the medium to longer term. So I think, I mean, this debate has come up more recently because the underperformance of some of the large cap funds vis-a-vis the benchmark. Uh, what I personally believe is that it's an aberration because we've seen some of the few large index where the market breadth and the rally has been very narrow, as you discussed earlier. A few stocks or top 4, 5 stocks would have actually driven the index movement, especially Nifty if you look at it. And I think, and that's the reason for the underperformance. But I think that there's some kind of a mean reversion, okay, which will happen over a period of time. There's no doubt that the outperformance of the actively managed funds is coming down and will come down over a period of time as we see the market matures and the size of the actively managed funds becomes larger. But I think India market still provides enough opportunity for actively fund managers to generate reasonable alpha vis-a-vis the benchmark over a longer term time frame. When I say longer term, means over a 3 to 5 year time frame. So I think, but for common investors, I think passive funds also can be one alternative, low expense ratio, and also especially if you want to take a directional movement, short-term call on the market to add beta to the portfolio, then a passive fund would make a sense. But if you really want to create wealth and invest into the market and you're looking for a wealth creation, then I think active funds still are the best alternative for investors to look rather than going into the passive funds.
Fair enough, Mahesh. One last question before I let you go. What's your take on ETFs? Is it too early in India yet? Is it too early for India yet?
It is just beginning, I would say. Yeah,
Okay.
the ETF, we've seen the ETF category is essentially driven by the EPFO and the pension fund money which is coming in. That those are large investors who are investing into ETFs, and as the market, this is mainly into the Nifty ETF or the large benchmark indices. But as the market matures, you will see much more complex ETFs coming in. There are certain sectoral ETFs, okay, which would also start to gain some prominence. We already have the banking and financial services ETF, which is there. So I think the industry will definitely grow from here on, and as we see more participants coming into the market. So we're still in the early stage. I think the ETF industry, if you look at on an incremental basis, would be contributing almost like 10 to 15% of the inflows. But on overall base, if you look at it, it will be still around 6 to 7% of the total assets under management. And slowly, I think it will grow over a period of time. And yeah, so in that sense, I think we are still in the early stage for the ETF industry in India.
Right, right. Interesting. Done. Mahesh, thank you so much for taking time off and joining us. I hope we get an opportunity to do another webinar with you sometime soon. Hopefully, we don't wait for another 2 years to get you.
Sure.
Yeah. So once again, thank you so much, Mahesh.
Yeah. Thank you. It was a pleasure talking to you.
Yeah. Bye bye.